Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Vertiv.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we dive into how they are solving this massive physical bottleneck in the market, here is a really useful chart tool for you. If you're looking for help reading trading charts more clearly, you can check out VIP Algos.
Yeah, it's pretty handy.
Right. So VIP Algos is a TradingView indicator suite, and it shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop loss planning areas. It works across a bunch of markets like, stocks, Forex, crypto, gold, all that.
Totally.
And it's designed to be really beginner friendly. But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice. It does not place trades for you, and it certainly does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. The link is below in the description. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. So look, imagine trying to drop a high-performance Formula One engine into like a standard commuter car.
That sounds like a disaster.
Right. Because the engine produces unbelievable power, but the moment you press the gas pedal, the standard radiator just completely melts down. The chassis overheats and the whole vehicle grinds to a smoking halt.
Yeah, just totally fries.
Exactly. And we are seeing that exact physical bottleneck play out right now in the artificial intelligence revolution. I mean, everyone is obsessing over the software algorithms, the microchip.
Oh, constantly.
But the real ceiling on AI isn't digital at all. It's the physical constraints of power and thermal management. So today we're doing a deep dive into the company attempting to build that high-performance radiator for the AI industry. And this stock is up, 90.5% year to date?
Yeah, roughly 90.5%. It's been wild.
Which is crazy. And seeing a stock up nearly 200% over a 12-month stretch instantly triggers this specific anxiety for anyone watching from the sidelines.
Oh, the FOMO.
Yeah, the immediate fear is that the train has just completely left the station. Like, are we just staring at the late stages of a crowded momentum trade? Or is this, the foundational stage of a much longer structural shift that long-term investors still really need to pay attention to?
Right, and to answer that, you really have to pull back and look at the secular multi-year trend driving this whole thing. Like, this cannot be viewed as a short-term meme stock or just a quick flip.
All right, let's move into the wealth building context.
So this is essentially the core infrastructure play for the entire AI supercycle. You hear analysts call this a picks and shovels investment all the time.
Right, referencing the gold rush.
Exactly.
Yeah.
The people selling the shovels made way more consistent money than the people actually digging for the gold.
I hear that picks and shovels phrase thrown around constantly in finance, but it feels a bit tired here, honestly. I mean, a shovel is a simple commoditized tool that literally anyone can make. Vertiv's position is way more complex than that.
That's true.
Like going back to that race car analogy, software companies are fighting this brutal war to build the fastest autonomous vehicle, right? And ship makers are building the engine. Vertiv is constructing the highly specialized thermal and power delivery systems that prevent the entire multi-billion-dollar project from literally catching on fire.
Yeah, that paints a much more accurate picture of the necessity here. Because regardless of which software giant actually wins the AI arms race, their massive data centers require just unprecedented amounts of electricity.
Unbelievable amounts.
And highly advanced cooling systems just to function at all. So for a growth-oriented investor, this really fits the profile of a capital-light compounder.
Okay, unpack that term a bit.
Sure. So, it's a business capable of growing its revenues rapidly and compounding its wealth without having to, constantly pour massive amounts of its own cash back into building new, expensive manufacturing plants every single year.
Got it. And that profile is incredibly appealing. But we also need to be really realistic about who this stock is actually for. I mean, a 200% run brings inherent volatility.
Oh, absolutely.
If you are an income investor who relies on steady dividends and, low blood pressure, or a speculative trader trying to time a quick intraday bounce, the premium valuation attached to this stock right now might cause some serious heartburn. You're paying a huge premium for aggressive future growth.
Which really brings up the most vital test for any growth narrative, right? Like, it is remarkably easy to sell a compelling story about the future of AI when the stock chart is pointing straight up.
Too easy.
But if we lift the hood and examine the actual cash this business is generating today, We really need to see if the financial reality matches the market's enthusiasm.
Now let's look at the fundamentals.
So the numbers coming out of their first quarter of 2026 are just highly persuasive. We're looking at organic revenue growth of 23%.
Wow.
Yeah, hitting $2.65 billion. And what really jumps out from that data is the America segment.
Right, I saw that.
Yeah, it exploded with a 44% organic growth rate on its own.
Wait, 44% organic growth just in the Americas?
Just in the Americas. The demand inflection in that region is so violent that management actually had to revise their full-year guidance upward.
Makes sense.
Yeah, they're pointing to a new midpoint of $13.75 billion in revenue now.
But, I mean, tracking top-line revenue is really only the first step, though, right? Because anyone can artificially inflate revenue if they spend aggressively enough on marketing or if they just deeply discount their product.
Exactly.
The true quality of a business is revealed by how much of that incoming money actually cascades down to the bottom line as actual profit.
So let's break down the mechanics of their profitability then, because they reported an adjusted operating margin of 20.8%.
Which is really strong.
It is. That represents a massive 430 basis point jump compared to the previous year.
And just to clarify the jargon for anyone listening, a basis point is just 1/100th of a percentage point. So a 430 basis point jump means their profit margin improved by 4.3 full percentage points.
Right.
They are squeezing significantly more profit out of every single new dollar that comes through the door.
And that phenomenon is the textbook definition of operational leverage. As their sales volume scales up, their fixed costs, things like their corporate headquarters or baseline administrative expenses.
They'll stay flat.
Exactly. They stay relatively flat. So a massive chunk of that new AI infrastructure revenue becomes pure profit. And you can see this vividly reflected in their cash flow.
Let's talk about the cash flow.
In just the first quarter of 2026, they generated $653 million in adjusted free cash flow.
That's insane.
It's a 147% increase from the year prior. Furthermore, their balance sheet is just remarkably clean. Their net leverage sits at just 0.2 times, meaning they carry virtually no debt burden relative to their earnings power.
Okay, so they are throwing off cash and operating with a pristine balance sheet. I get that. But let me challenge the durability of this success for a second.
Go for it.
Why are they the ones winning these contracts? What is the actual competitive moat preventing, say, a massive global manufacturing conglomerate from swooping in, undercutting them on price, and just stealing those data center clients?
Well, the defense against that comes down to excruciatingly high switching costs. Vertiv operates this highly specialized global army of about 5,000 field service engineers.
5,000.
Yeah, it's massive. And when our hyperscale data center, these massive warehouse-sized server farms run by the major tech companies,
Right.
when they install Vertiv's power and thermal systems, those systems are integrated into the very lifeblood of the facility.
Oh, so this goes back to the idea of replacing a jet engine while the airplane is cruising at 30,000 feet.
Exactly.
If you are operating a multi-billion-dollar data center, you cannot simply power everything down for a week just to swap out the cooling pipes for a slightly cheaper competitor.
No, absolutely not.
Doing so introduces an unacceptable level of catastrophic operational risk. I mean, the data center cannot afford a single second of downtime, which effectively locks them in, creating this incredibly sticky, recurring revenue stream for Vertiv's maintenance and service divisions.
And that recurring service revenue provides a robust baseline of stability.
Yeah, I understand the service revenue being sticky, but let me push back on the hardware side of the equation.
Okay.
Isn't this massive AI build-out essentially just a one-time cyclical boom? Like, once these tech giants finish constructing these data centers and the physical cooling racks are actually installed, doesn't the hardware revenue growth just hit a wall? We cannot build warehouse-sized data centers at this accelerated pace forever.
Right. That is a very common skeptical view, assuming this is just a cyclical peak. But that perspective completely ignores the rapid technological evolution happening right beneath the surface.
How so?
Well, Vertiv is actively transitioning away from being a mere hardware vendor into acting as an end-to-end engineering partner. They'd executed some highly strategic mergers and acquisitions recently,
Like who?
bringing companies like Coolterra, Pergerite, and Strategic Thermal Labs under their umbrella. And these specific acquisitions give them a vice-like grip on a technology called direct liquid cooling, or DLC.
Ah, and this is where the sheer physics of computing power become unavoidable.
Yes, exactly. The traditional method of cooling data centers for the past 2 decades has basically been pushing massive amounts of chilled air through the server aisles.
Right, big fans.
But when you look at the new generation of AI chips, specifically the massive 130 kilowatt Blackwell GPU racks being deployed,
Those run incredibly hot.
they run so intensely hot that traditional air cooling physically cannot absorb and remove the heat fast enough. It's literally like trying to cool down an industrial furnace by blowing on it with a desk fan.
Wow, so air just doesn't cut it anymore.
Not at all. You have to run chilled liquid directly to the cold plates attached to the chips themselves. Liquid is far denser than air and absorbs heat at a tremendously faster rate. Direct liquid cooling is no longer just a luxury upgrade. It is the only viable physical solution to prevent catastrophic hardware failure.
And Vertiv effectively owns that entire thermal chain.
They do.
That brings us to the catalyst timeline.
So pivoting to that, from air to liquid cooling is a fascinating mechanism. But how does that technological shift translate into the immediate timeline for investors?
Right.
We're looking ahead to the second quarter 2026 earnings expectations, right, which should arrive in late July or early August.
Right.
The consensus on Wall Street is projecting a staggering 47% growth in EBITDA.
Which is earnings before interest, taxes, depreciation, and amortization.
Correct. And that feels like an enormously high hurdle for any physical hardware company to clear.
It really does. But the expectations are monumental because they have overwhelming macroeconomic winds pushing them forward. Like the International Energy Agency, the IEA, recently published projections stating that global data center electricity consumption will double by the year 2030.
Double. That's massive.
And within that massive figure, AI-specific power consumption is expected to completely triple.
Wow. We are talking about power requirement that will test the absolute physical limits of global electrical grids.
Yeah, it is no longer just about the tech companies having the cash to pay the electric bill. It is about whether local municipalities and power stations can physically generate and deliver that much continuous, uninterrupted wattage to a single building.
Without causing rolling blackouts for the surrounding city.
Exactly.
Which is exactly why thermal and power efficiency is just paramount right now. If you can cool a facility using 20% less power by utilizing advanced liquid cooling, that saved power can be rerouted to run more computing chips.
Makes total sense.
And this urgent need for efficiency is the driving force behind another major catalyst, which is their expanded, deep-rooted ties with NVIDIA.
Oh, let's talk about NVIDIA.
Yeah, Vertiv isn't just shipping generic cooling racks to data centers that happen to buy NVIDIA chips. They are actively co-developing a highly specialized 800-volt DC power architecture directly with NVIDIA.
That's a huge integration.
It is. Furthermore, they just launched a software platform called the SmartRun Digital Twin, which integrates directly with NVIDIA Omniverse.
Okay, let me make sure I understand the mechanism of a digital twin in this context. This implies a data center operator can use software to build a fully functional, three-dimensional virtual simulation of their proposed server farm, right?
Yeah, exactly.
So they can test the electrical loads, simulate the extreme heat output of the GPUs, and optimize the complex liquid cooling routes digitally long before they pour a single ounce of concrete or purchase a physical copper pipe.
Precisely. It completely de-risks the construction process. It allows engineers to identify thermal bottlenecks in a virtual environment, potentially saving hundreds of millions of dollars in design flaws and physical retrofitting later on.
All right, here's where my skepticism kicks into high gear, though.
I figured.
Because everything we just walked through is undeniably impressive.
Yeah.
But none of it is a secret. The broader market is fully aware of the IEA's power grid projections. Hedge funds have read the press releases about the NVIDIA code development. Management themselves have loudly broadcasted a target for the year 2030, aiming for 20 to 22% organic compound annual growth and pushing their profit margins up to 27%.
They have been very vocal.
So if a company is this incredibly transparent about their long-term trajectory, hasn't Wall Street already priced all of this future success into the stock today?
And that is the ultimate dilemma of investing in hypergrowth companies, right? The market acts as an efficient discounting mechanism. It constantly attempts to pull future expected value into the present day's share price.
Right.
To determine if every drop of that future perfection is already baked into the valuation, we have to pivot away from the balance sheet and examine how the market is physically trading the stock right now.
Now let's pivot to the chart.
Looking at the current price structure, there is a very distinct story of consolidation unfolding on the chart.
What's it doing?
The stock has been trading in a tight sideways channel, roughly between $315 and $335, just hovering slightly below its all-time highs.
Okay.
Zooming out on the chart, The overarching multi-year trajectory is undeniably a structural breakout. It has been the last year consistently carving out higher highs and higher lows, proving the long-term trend is firmly intact.
Right.
But this current hesitation, this sideways chop right near the absolute top, is crucial to monitor.
Because that hesitation reveals a deep underlying vulnerability. I mean, I look at what happened on June 10th as a perfect example of this.
Oh, yeah?
The stock showed extreme sensitivity to intraday reversals based on a completely unrelated macro shock. There was a breaking news headline about a geopolitical helicopter incident, something that had absolutely zero connection to data centers, liquid cooling, or artificial intelligence.
Not at all.
And the stock twitched violently downward. To me, that is the textbook definition of a stock being priced for perfection. When you are trading exactly in line with your absolute best-case scenario, any broad market anxiety, any ripple in the global news cycle can trigger a sudden drop as nervous investors rush to lock in their profits.
And that is the harsh reality of carrying high momentum. The underlying foundation of the business is incredibly solid, but the day-to-day, hour-to-hour price action becomes incredibly noisy, reactionary, and unpredictable.
And honestly, if you are an active trader trying to navigate that kind of intraday chop on a stock that reacts violently to every headline, having clean visual tools to map out support and resistance becomes essential. You really need to clearly see where the structural price floors are located so you don't get shaken out of your position by random noise.
Which brings us back to the psychological meaning of that hesitation at the top of the chart. That sideways consolidation is essentially a visual footprint of a massive tug-of-war happening behind the scenes right now between entirely different types of market participants.
So what does market sentiment look like?
Well, let's break down the two sides of that tug-of-war. If you look at the institutional sentiment, the bullishness is almost deafening.
How so?
The mean target from Wall Street analysts is currently sitting at $377, with the most aggressive upside targets reaching $500.
500. Wow.
Yeah, and we are also seeing serious, aggressive whale accumulation. State Street, one of the largest and most influential asset managers in the world, just increased its position in the company by a staggering 82%.
That's huge.
The heavy-hitting institutions are effectively backing up the truck and loading up on shares.
But pulling hard on the other side of that rope is a glaring, deeply uncomfortable red flag.
Yeah.
If you analyze the insider flow, meaning the actual executives, founders, and board members inside the company, over the last 6 months, there have been 64 recorded insider sales. Do you know how many insider purchases there have been in that exact same window?
Let me guess.
0. Not a single share bought.
And if you are an individual investor sitting at home holding this stock right now, seeing the executives aggressively cash out while the price hovers near all-time highs is enough to make you lose sleep.
Exactly. Because if the NVIDIA integration is so groundbreaking and if they have billions in locked-in contracts, why are the architects of this success aggressively taking their chips off the table?
It is the single most common fear for retail investors, and on the surface, it looks terrible. But we have to analyze the actual mechanics of the market to understand this dynamic.
Okay, lay it out.
First, consider the human element of personal liquidity. If a massive portion of your personal net worth was tied up in a stock that just surged 200%, basic financial prudence dictates that you diversify your wealth.
Sure, especially when the valuation is sitting at a massive premium.
Right, but far more importantly, you have to weigh that insider selling against the sheer, undeniable gravity of passive fund flows. Vertiv was recently included in the S&P 500 index.
Oh, and that is a critical mechanical detail.
Yeah.
When a stock enters the S&P 500, massive index funds and ETFs run by giants like Vanguard or BlackRock are structurally forced to buy millions of shares to accurately track the index.
They don't have a choice.
Right. They have to buy regardless of whether they think the stock is expensive or cheap.
Precisely. Add that forced structural buying pressure to the ongoing speculative chatter about Vertiv making further software-defined infrastructure acquisitions.
Right.
And you have institutional demand that is more than powerful enough
Yeah.
to absorb and wash out the insider selling without crashing the price.
Okay, that makes the insider selling less terrifying, but it still leads us directly into the harsh reality of the valuation risk.
Now let's talk about the risk.
Because we just cannot ignore this metric. We are looking at a stock trading at roughly 50 times its expected full year 2026 earnings and 9 times its total sales. That multiple leaves zero room for error.
It is a highly unforgiving valuation that demands absolute perfection.
I want to explicitly explain what multiple compression actually looks like for a stock like this. Because if Vertiv experiences any deceleration in how fast they convert their contracts into actual revenue, or if they stumble and miss that 27% profit margin path they promised for 2030, the market will punish them violently.
Oh, absolutely.
Severe multiple compression means Wall Street stops treating them like a high-growth tech darling deserving of a 50x multiple and immediately starts pricing them like a boring traditional hardware company. The underlying business might still be growing and generating cash, but the stock price could plummet 20 or 30% simply to bring the valuation multiple back down to earth.
And that is the primary financial risk hovering over the stock. But alongside that, there's a profound operational risk, which is the competitive landscape.
Talk about the competition.
We spent a lot of time praising their dominance in direct liquid cooling, right?
Yeah.
And they do hold a highly lucrative first-mover advantage right now.
Yeah.
But massive global conglomerates like Schneider Electric, Eaton, and various well-funded Asian equipment manufacturers are not sleeping. They see the billions flowing into the AI boom, and they are aggressively scaling up their own liquid cooling manufacturing capacities.
Obviously.
So the long-term risk here is commoditization. By 2027 or 2028, if liquid cooling technology becomes standardized across the industry, Vertiv could severely lose its pricing power.
And if cooling becomes a heavily discounted commodity rather than a specialized premium service, those ambitious 27% margins become a pipe dream.
Exactly, which gives a very logical, fundamental reason for why those insiders might be aggressively selling today. They know the competition is finally waking up and preparing to flood the market with cheaper alternatives in a few years.
Right. That is a highly valid read of the situation.
However, there is a massive mitigating factor that acts as a financial fortress against that near-term competitive threat.
What's that?
They're currently sitting on a $15 billion backlog of orders.
Let's clarify what that backlog represents, though, because that is not a theoretical pipeline of potential leads or, speculative interest from tech companies.
No, these are signed, locked-in commercial contracts.
Yeah.
That $15 billion provides 12 to 18 months of absolute guaranteed revenue visibility.
That's a huge buffer.
It really is. If a cyclical macroeconomic recession hits tomorrow, or if a major competitor launches a flashy new product next week, Vertiv already has a year and a half of guaranteed, highly lucrative work queued up to buffer against it.
Right.
And in the volatile infrastructure space, having that level of crystal clear forward visibility is incredibly rare and highly prized by Wall Street.
So, synthesizing all of this data, we are looking at a company uniquely positioned to capture the tremendous upside of the AI infrastructure boom, buffered by a massive multi-billion-dollar backlog, but it is weighed against a premium valuation that demands flawless execution and largely ignores the looming threat of future competition.
Yeah, that's the setup.
So with everything on the table, what's the final verdict?
Based on the undeniable quality of the underlying business, their expanding competitive moat in liquid cooling, and the massive macro tailwinds stemming from AI power demands, the verdict lands on a bullish score of 8 out of 10.
Wow, an 8 out of 10. That is a highly confident score, even with our stated concerns about the unforgiving 50x valuation multiple.
It is confident, but it requires the correct psychological approach and investment horizon. Like, this is not a setup for a quick swing trade.
Right.
If you frame this as a multi-year hold, specifically targeting a 2 to 3 year time horizon, you allow the core thesis enough time to actually play out. You give the company the runway needed to execute the physical conversion of that $15 billion backlog, and you allow them to steadily march toward that 2030 margin framework.
So to summarize it clearly for everyone listening, the primary upside driver here is their widening, highly specialized competitive moat in direct liquid cooling, fortified by their deep co-development integration with NVIDIA. They are solving a physical, thermodynamic bottleneck that the largest technology companies in the world are desperate to overcome.
Exactly.
But the primary downside risk remains the premium valuation and the ever-present threat of multiple compression. Trading at 50 times future earnings means you're paying a very high-quality price for a high-quality company, leaving absolutely no room for operational missteps, supply chain failures, or aggressive competitive pricing.
That perfectly encapsulates the risk-reward balance investors face here.
Just a reminder to everyone tuning in, our discussion today is not financial advice. We are analyzing the data and market mechanics, but you always have to make your own decisions and manage your own portfolio.
Always.
And if you want a cleaner way to read trading charts to help with those decisions, check out VIP Algos. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you. The link is below in the description.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
It really leaves you with one fascinating, almost philosophical question to mull over as you watch the market this week. As humanity races to build these artificial superintelligences, pouring billions of dollars into advanced software and microscopic silicon chips, the ultimate constraint on our progress isn't code or digital innovation. It's whether the physical copper, the water pipes, and the local power grids of our physical world can actually handle the soaring ambition of our digital one. Until next time.